Okay, so once we understand these kind of scenarios and the different model they follow, once we grasp upon a little bit about how these all behave, then we can find out what actually could happen in terms of the scenario. So we calibrate all these to market codes, which means that if we are looking at a horizon, we'll make sure that we are using the entire cycle. So if we are using an equity cycle, we'll rather say that equity is going to behave in the way it has behaved in the last 10 years, so that we take in the entire cycle. If we take the codes from 2008, we'll have an upward bias in our equity estimates, and the same ways we are going to calibrate our model. We are going to use the right time frames. We are going to understand how to understand the cycle, what are the definitions of the cycle, what is the definition of the regime, what are the indicators of those regimes, and so on. So we can generate them. So with respect to that, we'll move to Basel norms, to Copula, and Copula becomes important here because of a few things. Let me talk a little bit about that. So when we look at the credit risk part of the stress testing, the credit risk part would involve simultaneous defaults of different companies. So whenever there is a downgrade of one company or one sector, there is a probability that the entire sector is behaving in that way, and there would be serial default. So when we talk about default of two things going down, we cannot use the normal correlation, because all these things are different, are linked together in a not so simple way. That's one way to look at how we would use copulas. The other way is to look at it in terms of where things are normally distributed. We'll use a normal copula. So if two things are there, they are normally distributed, and we want to find out what's the correlation between them. So our normal correlation method would fail. So in that way, copula would be a better match. So based on these areas, we would prefer copulas to calculate some of the replacements of correlation in terms of default and other distributions. The next part is EVT, that is extreme value theorem. Again, we'll use this because the extreme or the tail events have a different probability and the different intensity of loss. So if we use the normal distribution, we are going to ignore those tail events. So we'll rather fit in an EVT distribution so that we can get the right estimate of what could happen in that extreme event. If we use a normal distribution, then we are doing an upscale bias where we are not considering in the tail events. Then we have the cards for the volatility projection and the counterparty risk projection and the stressed bar. If you remember stressed bar, it's like a maximum of t minus 1, or the average of the last month, and things like that. So uh, if the market scenario changes, if we are making more loss, then we are going to increase our value at risk. So this was a little bit about the quant part. Now moving back to the qualitative part that we had to initially discuss, I'm going to now move to the qualitative part here. So the capital adequacy is something that banks are worried about. This is quite similar to liquidity. So here we need to understand the details of 2009 supervisory capital assessment program, the first stress testing required after 2007 and 8 financial crisis, and the issue of coherence in stress testing and the challenges in modeling balance sheet using stress test in context of the stress test horizon is again quite important. So for the US and the European stress test, there is a little different methodologies that they are following. Now we move to the stress testing. So in the wake of 2007 and 2008 financial crisis, regulators and other policymakers realized that standard approaches to risk assessment, such as regulatory ratio requirement, were not sufficient. At that point, supervisory stress testing became a popular tool for measuring bank risk. There is a pop-up quiz quality to the post-financial crisis stress test. They were difficult to manipulate uh, because they were sprung on the bank at short notice. As a result, information provided by stress tests to regulators and the market was truly new. This allowed financial market to better understand bank risk, and as a result, regain a level of trust in banking sector. So the goal of stress testing, which is very similar to capital and liquidity, and the economic capital and liquidity, that is internal and bank specific models, is to assess how much capital and liquidity a financial instrument needs to support its business. And by business of a bank is to take risk. It is relatively easy for bank to swap out lower risk assets into higher risk assets. Stress testing provides clarity about how these two risk and thus take us to the right soundness of the bank. So this is an old tool that the banks and the other firms have used to examine risk. It asks the question, what is the institution resilience to deteriorating condition, and simulate financial result given various adverse scenario. Stresses are generally of two basic types, scenarios or sensitivities. An example of scenario is severe recession. Example of sensitivity is increase in interest rate. Risk manager can stress test again a single position or loan or an entire portfolio. Now let's move to supervisory capital assessment program. In the wake of financial crisis, there was much uncertainty about the soundness of banking system. Regulators need to assess the capital strength of financial institution, and there was a gap between bank needed in terms of capital and what it had. So the regulators had to find a credible way to fill in that hole. In 2009, bank stress test known as supervisory capital assessment program was meant to serve the purpose. It was the first macroprudential stress test after 2007-8 financial crisis. Macroprudential regulation focuses on soundness of banking system as a whole, while macroprudential regulation focuses on safety and soundness of individual institution. At this point, the federal government planned to infuse equity into the banks that were undercapitalized based on stress testing. The Treasury intended to borrow money and downstream it as equity in the banks via Treasury Capital Assistance Program, which is TCAP. The banks could not convince investors to fill in the hole and infuse, uh, and if the bank were not doing well, then the current investors should be diluted using government's equity investment. In 19, SCAP banks were requested to raise 75 billion within 6 months. The undercapitalized banks raised 77 billion of tier 1 common equity and did not need the draw of cap funds. Prior to 2009, stress testing was relatively simple, and let's understand how it differed before and after the SCAP. So before the SCAP, the primary assess exposure to single shocks like volatility or interest rate or increasing unemployment. But now we have the macro scenario, the market-wise stress test, multiple factor test, which actually happened in 2008. So group of parameters change as compared to just one thing. Focused on specific bank products or business units, and now it focuses on the whole firm, so it's a comprehensive test. And before it was typically focused on earning shocks but not on capital adequacy, but now we are explicitly focused on capital adequacy. Focused exclusively on losses, but we focus on revenues, cost and projected losses. Earlier it was static in nature, now it is dependent on path, and it's a lot more dynamic. So let's understand the word coherence and the challenges of designing a useful stress test and how coherence play an important role. So the sensitivity scenario must be extreme but also be reasonable or possible, which means they should be coherent. Problems are inherently multi-factored, making it more difficult to design a coherent stress test. For example, an increase in volatility can lead to a credit market freezing. High unemployment or falling equity often go hand in hand. It is not sufficient to specify one potential problem because others don't remain fixed. A supervisor's key challenge to identify the joint outcome of all the relevant. So supervisors will give us the scenario of how joint they are. Additionally, not everything goes bad at once. If some currencies are depreciating, other must also be depreciating. If there is a flight to quality, there must also be safe havens in the stress model. So while it is important to look at, for example, what happened in US Treasury that became more riskier and is no longer safe haven, the model would be at the same time identify a risk-free asset which would flee under those circumstances. The problem is even greater while deciding stress scenarios for market portfolios. Risk is generally managed with a value at risk system. Hundreds and thousands of positions in the trading book must be mapped to those risk factors traded on daily basis. The data that results is used to examine volatility and correlation parameters. It's very difficult to find coherent outcome in such a complex and multi-dimensional universe. So uh, many things will move hand in hand, and it would become really difficult to specify what would happen, what would not, uh, even if we change one factors to test. So in 2009, SCAP tests rather simple scenarios with three variables: GDP, unemployment, and housing price index. Historical evidences and experiences were used for market risk scenarios like financial crisis, period of flight to safety, the failure of lemon, high risk premium. While the market risk did not test for something new, the overall framework achieved coherence of financial and other stress of the time period. Now, one thing to note is prior to 2011, all supervisory stress tests imposed the same scenario for all bank, which is like one size fit. In recognition to the problem, 2011 and 12 comprehensive capital analysis review assessed bank to submit result for their own stress testing scenario in addition to supervisory stress testing scenario in attempt to reveal bank specific vulnerabilities. This is an important step from 2009 as it gives supervisors a sense of what banks think are high risk scenarios. This provides regulators with not only bank specific insight but also improved macroprudential supervision to highlight common risk across banks which remains unnoticed. So not just the supervisor will give you that scenario of what's happening. The banks will now also be giving their own ideas about what would actually happen. Now let's understand the challenge in mapping from broader macroeconomic to specific intermediate risk factor in modeling losses. So current stress tests are based on macroeconomic unemployment, GDP growth and HPI. One concern is how to translate the macro risk factors employed in stress testing into micro outcomes related to revenues. On supervisors need to map from macro factors into intermediate risk factors that drive losses in specific products and geographical areas. Although not limited to these product geography, differences are especially important in modeling losses in both commercial and residential real estate lending. Credit card losses are particularly sensitive to unemployment figures. For example, unemployment was 12.9% in Nevada in July 2001 and it was like 3.3% in North Dakota, whereas the national unemployment was 9.1. The credit card losses vary dramatically from region to region. The geographical diversified with respect to macro feeders, one size field will become meaningless if we look for what would happen to the credit card losses. So geography is not the only difference. Supervisor must be content with risk affect different asset classes in different way. For example, recession, people buy fewer automobiles. However, if a person needs a car during recession, is more likely to buy a used car. Thus, the default rate increases. Loss given default may not increase as much. So the business cycle can also affect different industries at different time. Consider the airline industry versus healthcare industry during recession. Airplanes are collateral for loans to airlines. If airline industry is depressed, the banking gets stuck with collateral that is very difficult to sell except at extremely depressed prices. Healthcare is somewhat recession proof. That means bank cannot transform and plane and stuck into a hospital. So these factors affect the firm having broader securities to a bank specific stress test. And this is again a challenge with the quant part. So if you are modeling how the healthcare would behave sector, then it's very different from the bank, the aeroplane industry or the airplane industry. So challenges with balance sheet modeling. The typical stress horizon is 2 years. Over that period, both income statement, balance sheet must be modeled with adequate stress. Generally speaking, capital is measured as a ratio of capital to assets. These are different type of capital, that is tier 1 and tier 2, but in general and for the sake of simplicity we can define as common equity. Risk weighted assets are computed based on Basel II risk weight definition, and the agencies have a lower risk weight than credit card loans. So in the stress model, beginning balance sheet generates the first quarter's income losses from the stress scenario, in which in turn determines the quarter end balance. At that point the person might the person modeling the risk might consider all assets will be sold or originated if capital is depleted due to actions such as acquisition or conserved as a result of spin-off. There are chances to make a dividend payment if shares can be repurchased or issued. So the decision made modeling the balance sheet over stress horizon becomes quite difficult. The stress model does not determine if it will be a good time to sell a subsidiary or lower the dividend payment. So this is again an interesting thing, the kind of share repo that was aggressively taken over in spite of the risk in the banking sector, and we don't have any mechanism how to map that and talk about whether a share repo is making it more riskier for the banks or not. So the challenges of balance sheet modeling exist in both static and dynamic modeling assumption. A bank must maintain its capital and liquidity ratios during all quarters of the stress test horizon. At the end of the stress test, the bank must estimate the reserves needed to cover losses and at least for the next year. This means that a 2-year horizon is actually a 3-year horizon. So compare and contrast the 2009 SCAP test, the 2011 and 2012 CCAR, the 2001 EBA Irish and EBA European test in their methodology and finding. So disclosure was significantly feature of 2009. It disclosed the projected losses for each of the 19 participant banks for 8 asset classes. It also disclosed resources the bank had to absorb losses other than capital, like pre-provision net revenue and reserve release if available. If this level of disclosure created this level of disclosure created transparency, it allowed investor and market to check the severity of stress test and to comprehend stress outcomes at individual bank level. So before 2009, bank only reported the realized loss, not the forecasted loss or the possible loss given the scenario. In 2011, CCAR required only macro scenario results that published, not the bank level result. This differed dramatically from 2009 SCAP requirement. The market had to figure out whether a bank had passed the test or not, and if the bank has increased its dividend, it assumed by market that it has passed the test. However, 2012 disclosed virtually the same amount of detail level uh, and the bank level loss rates and the loss by major crash losses. So regulatory assets are classified as first and second line mortgages, commercial and industrial loan, commercial real estate loan, credit card lending, other consumer loan and other loans. So these are the lendings. One of the key contributors of CCAR is that in both 2001 and 12, the CCAR required bank to submit results of their own scenario, both baseline and stress, not just supervisory. The Fed also reported dollar pre-provision net revenues, gains and losses available for sale, held for market and trading, and counterparty losses for 6 institutions with large trading portfolios. So this is an interesting thing. So not only you have to submit your credit risk, but a kind of a market risk like trading held to maturity, counterparty losses, and you have to report them. So these firms required to conduct trading book stress. The number that were reported were supervisory estimates, not bank estimates of losses under the stress scenario. So in contrast, the 2001 European Bank Authority Irish and 2001 European says both disclosed the CCAR contained considerable detail. In the Irish case, the report contained a comparison of bank and third party estimates of losses. The EBA data was available in electronic and downloadable form. Ireland need credibility, having passed the test in July and only need to consider it for 4 months. In general, faith in European supervision was harmed, and only by disclosing detailed information by bank by bank, asset class, country, maturity could the market interpret the data and draw its own conclusion about the bank. So this also became, in fact, a better idea to come out of the crisis that Europe has failed, where they were discussing and giving out details about what's happening in the bank. So let's understand comparison of macro prudential stress test. So a stress test, and I'm going to talk about a stress test, its methodology, disclosure and finding. So we are going to talk in a chronological order, where we are going to start with 2009 and land with the latest 2001 EBA Europe. So we are going to talk about 5 of these stress tests one by one now. So in the 2009 SCAP, all banks with 100 billion or more assets as of 2008 were included. So focused on big banks. Tested simple scenarios with 3 dimensions: GDP, unemployment, HPI, historical were used for market risk like flight to safety, failure of Lehman, high risk premium, one size all fit approach, first to provide bank level assets, and the bank were finally required to bring 75 billion, which they did. Now 2011 CCAR, the recognition of one size fits testing CCR submit the bank's own ideas. So the bank did publish their ideas about the kind of stress test that they believe could happen. Now CCAR 2010, bank were again asked to submit their own baseline and stress test result. So the bank level and asset product level rates were disclosed. Now EBA Irish, similar to design of EBA Europe, comparison of banks' third party projected losses and comparison by asset class geography, data is electronically downloadable. So after passing 2001 test, stress revealed that Irish Bank needed 24 billion. Greater disclosure in 2000 resulted tightly classified Irish sovereign and individual bank debt. EBA Europe, formerly known as Committee of European Banking Supervision, 90 European banks were tested. 8 macro factors were taken, and for each 25 countries, and specified 70 risk factors for trading books. Also imposed several haircuts across the 7 maturity buckets. So bank level projected losses, comparison of exposure by asset class and geography data is downloadable, and 8 bucks were required to raise 2.5 billion euros. So this is how it happened. The key benefits of greater disclosure is transparency. Transparency is especially important in times of financial distress. However, during normal times, the cost of disclosure may overweight the benefit. This is something like buying a hedge in your portfolio again and again. So it will benefit only when you get in loss. So the banks may window test portfolio, making poor long-term investment decision to increase the likelihood passing the test. Traders may plant too much weight on public information, including trader disclosure may be disincentivized to produce private information. This harms the information cut of the market prices, and the market price is useful for regulators making policy decisions. One thing to note here is that prior to CCR 2011, all supervisory tests import the same scenario for all banks, and later they uh, change their approach, and also they ask their banks to give bank specific vulnerabilities that they think is going to affect. So after that we are going to look at international convergence of capital measurement and capital standard, but this would add in for the stress test banking. Thank you for listening to this audio. I hope this was useful. Trying to continuously get slides and add more interesting things. Maybe I'll release a better version in some time.